Interest rate hike after interest rate hike after interest rate hike. The hiking cycle has begun, and it seems like there's no end in sight. You might be wondering, when do the interest rates stop? And also, what are the potential implications for the broader economy as well as the market? Today we're going to dive into this question. Make sure you stay until the end because we'll actually talk about what this could mean for the current market correction that we find ourselves in. As you can see here, the Federal Reserve just recently hiked their interest rate by another 3/4 of a percentage point for the second consecutive time. It was an outsized hike, and we just had the RBA's hike as well. Fourth consecutive month, the first time since the introduction of inflation targets in 1990 that they've increased the cash rate 4 months in a row. And then flowing down, to set the scene, before we dive into the interest rate hiking cycle itself, we need to understand where we're positioned. Inflation's at 40+ year record highs. Over 9% was the last print over on the US CPI front. However, we also understand that it's not only inflation itself, but inflation expectations that are important. We know that if inflation expectations become embedded into the broader macroeconomic picture, it can become a self-fulfilling prophecy, where of course you start to see workers asking for higher wages. As a result of that, costs need to go up, and then it can flow in and flow on and so forth through the wage price spiral. And so this is what's at the back of the mind of all of the central banks around the world as they look to curtail this inflation. What we're looking for, what the market, analysts, economists are thinking about is, where does this neutral rate sit? So if you're not familiar with the term neutral rate, essentially it's the interest rate that supports the economy at full employment and maximum output while keeping inflation constant. To break that down into simpler terms, the neutral rate is essentially the rate where the economy is in equilibrium. The rate's not too hot, so it's not too stimulatory, but it's also not too restrictive for the broader macroeconomic picture. And there's a few interesting data points that we can use as proxies for sentiment from different cohorts of the market about where rates may head moving forward. Federal Reserve's dot plot is the first one. This is an indication from Federal Reserve officials for their projections for interest rates. Of course, it's worth noting that this is Federal Reserve's officials' predictions, but this is only with the current data that they have. They do this every so often at Fed Reserve meetings, but of course, this changes depending on the macroeconomic picture and different data points that flow through. So at the last meeting, we can see around 3 to 3.5% was the anticipated rate for the back end of 2022, slightly above that for 2023, before we start to see rates subsiding in 2024, and over the longer term, back towards a neutral rate in around that mid 2.5 level. But then we can see the market expectations here as well. And an indication of this here is with the inverted yield curve that we've seen over this past period. As many of you are familiar with, an inverted yield curve is a potential indicator. It's often viewed as a leading indicator of recession from economists. What it is, it's the indication and the spread between the short-term and the long-dated interest rates. A 2-10 spread is often looked at by economists, and we see that we've got an inverted yield curve now as well. We had a slight inversion earlier on in this year. We've had a more sustained inversion now. And all of this is giving an indication that with the spread of the 2-10 spread, that potentially shorter term interest rates may be higher than long run interest rates. It's the potential indication that central banks are going to have a difficult job navigating this soft landing. Potentially they may raise interest rates higher in the short run. We know they want to raise expeditiously to curtail this inflation, but will they be able to do it in a manner where they're able to stop the economy from overheating, but without causing a severe downturn or potentially, in a worst case scenario, a recession? As soft landing is becoming more and more narrow that they have to navigate, obviously, as inflation remains more persistent than initially anticipated, and obviously as they have to raise rates higher, then that narrower pathway opens up. We've seen growth slowing, 2 quarters of negative contractions in terms of GDP growth for the US, which is defined often as a technical recession. But this is what the market's looking for. Can inflation come down without us going too far into a recession? Without us going too far, into a downturn, and without them having to curtail growth too significantly. But on that matter, we know that there's 2 sides to the equation. Growth on one side, inflation on the other side. We know that central banks at the moment are prioritizing inflation as that key mandate. We know that inflation itself serves as a regressive tax. It has a disproportionate effect on the lower income earners. And so the central banks want to bring this down as quickly as possible. And they've highlighted, Jerome Powell, the Federal Reserve Chair's highlighted, they're willing to do whatever it takes to curtail inflation. And they also have started noting recession as a possibility with more of their discussions. It's not just the Federal Reserve, Reserve Bank of Australia, the RBA, Bank of England, Bank of Canada, other central banks around the world too. And so we know that they're front-loading interest rate rises. There's a discussion. Some economists have argued that potentially they were too late to the party in terms of raising interest rates and left them too long. But now central banks are trying to front load interest rate rises. Mark Carney, the former governor of the Bank of England, stated bankers need to catch up to their economies. They've been behind the curve. They've acknowledged this. They want to start getting interest rates above inflation effectively, or at least inflation expectations, so they don't become embedded into the system. And so with all of that, there's a lot of data points. What do we watch? First and foremost, we've just launched a second channel for investors, so make sure you've subscribed and turn your bell notifications on if you've enjoyed these videos. We've got to be cognizant of the fact that monetary policy tools are blunt, not precision tools, but they also operate with a lag time. It's not as if we see interest rates rise today and suddenly demand is curtailed tomorrow. It takes time to filter through and flow through into the economy. So the question with that is, obviously this makes it more difficult for central banks, is are they raising rates into weakness already? We're not going to know this until we see more data points, but there's a range of different things that we want to look for. Of course, you're looking at the labour market. This is where the central bankers are looking for weakness or signs of things breaking. Of course, growth on the other side as well, consumer expectations, retail sales, all of these areas are all data points that we can plug in to get a broader understanding. And with that, of course, we're still going to continue to watch all of these data points, but what does it mean for markets themselves? Interestingly, there's a range of different articles and a range of different statements that are anticipating that we might not see a bottom in this current correction or bear market until the Federal Reserve eases or we see that Fed pivot. It's worth noting that the Fed put is gone. As we know, puts offer downside protection. The Fed put was often seen as the fact that the Federal Reserve would come in and step in when we saw turmoil or a significant enough decline into the stock market. However, this was in a period where we saw record low rates and we didn't have runaway inflation. So it's anticipated that the Fed put is gone now. So the market's waiting to see, when does the Federal Reserve pivot? At what stage do we start to see whether we're at the neutral rate, whether they hike through that neutral rate, and when we start to see easing into the broader macroeconomic picture and what that means for the actual stock market itself. You can see a range of different strategists here have indicated the bottom might come in once a Fed signal shift. I'd love to know your thoughts. Drop in a comment below. It's a very interesting time. We'll continue to watch and update you all on everything playing out. A big thank you for joining us. For now, stay well and happy investing.